Okay, hello and welcome to today's webinar. This webinar is co-hosted by the Feed the Future Innovation Lab for Markets, Risk and Resilience and the Global Resilience Partnership. My name is Ida Gabrielson and I'm a Communications Officer with the Global Resilience Partnership. I'll be running the technical aspects of this webinar along with Sophie Javers, my co-host. So if you have any questions about the technical aspects or you need some help with anything, please don't hesitate to contact us in the chat box. Without further ado, I would like to hand over to our first speaker, Dion Nell, the CEO of the Global Resilience Partnership. Dion?
So thank you very much, Ida, and thank you so much for everyone who's joined. I understand that this is a big group, over 300 people registered, and a very diverse group. So really interested to hear your thoughts. As Ida says, I'm Dion Nell. I'm the CEO of the Global Resilience Partnership, and the Global Resilience Partnership is a vibrant community of more than 55 organizations, all joining forces to build resilience where it's needed the most. And we think of the Global Resilience Partnership as an open community or a safe space to innovate and share diverse ideas and perspectives on resilience, ultimately with the aim of maintaining or improving human well-being in the face of increasing volatile and uncertain times. So we're really delighted that the Markets, Risk and Resilience Innovation Lab, especially Michael and Sophie, have really taken the lead in putting together this excellent learning webinar on their Resilience Plus approach to reducing poverty and spurring agricultural growth. Now, the MRR Innovation Lab just joined GRP a few months ago and have jumped directly into leading this learning webinar. So really setting the benchmark of how to use this platform that the GRP is and to generate open and inclusive and diverse dialogue on these issues. So if there are any other GRP partners, be inspired to follow their lead. We realize that resilience means many different things to different constituencies, but I think we can all agree, based on the events of the last several months, that we're living in a more volatile, uncertain, and hyper-connected world with systemic risks. And so I think building a more diverse, robust, and resilient food system, I think, sits at the center of many of those systemic challenges we're facing. So a very timely dialogue, and thank you so much to the MRR Innovation Lab for taking the leadership on this. I will now hand over to a longtime friend and supporter of the Global Resilience Partnership, Jamie Montgomery. Jamie is the Division Chief for Resilient Communities at the Center for Resilience at USAID. Jamie, over to you.
Thank you, Dion, for that great introduction. And I wanted to add my welcome to everybody for today's webinar on generating resilience to reduce poverty and spur agricultural growth. As Dion mentioned, this is sponsored by the University of, the Markets, Risk and Resilience Innovation Lab, implemented by the University of California at UC Davis, as well as the GRP. The Markets, Risk and Resilience Innovation Lab was launched back in the summer of 2019 and develops and tests financial and market innovations that take the most promising agricultural tools for families in developing economies from the lab to the field. In addition, many of you are probably already aware of the breadth of UC Davis and its partners' research in these areas under previous iterations of this innovation lab under BASIS and the Assets and Market Access Innovation Lab. So it is my very great pleasure to introduce the director of the Markets, Risk and Resilience Lab, Dr. Michael Carter, as well as the speakers for today's presentation. Dr. Carter is a professor of agricultural and resource economics at the University of California at Davis. His research examines poverty dynamics and productive social safety nets, the impact of violence on aspirations and hope, small farm uptake of improved technologies, and features a suite of projects that design, pilot, and evaluate index insurance contracts as mechanisms to alleviate chronic poverty. We also have a really great lineup of speakers today. So I'll just quickly introduce them before turning it over to Michael. Geda Elabed, apologies if I didn't pronounce it quite correctly, is an agricultural economist at the Global Engagement Unit of the Agriculture and Food Global Practice of the World Bank. Her work spans the areas of agriculture policy, digital agriculture, risk management, and the energy and agricultural nexus. Andrew Mude manages the African Development Bank's Agriculture Research, Production, and Sustainability Division. His research deals largely with researching and designing risk management and development interventions to help increase resilience and reduce vulnerability among poor livestock-dependent households. He was also a pioneering researcher involved in the successful index-based livestock insurance program. Gregory Lane is an assistant professor of economics at American University. His primary research area is development economics, and current research focuses on innovations in finance and technology in developing countries. And then finally, Samuel Sinimba is a program officer at the Bill and Melinda Gates Foundation, where he manages a portfolio focused on rural and agricultural finance related to smallholder risk interventions in sub-Saharan Africa and India. So with that quick round of introductions, I'll turn it over to Michael.
All right, thank you all very much, and good morning, good afternoon, good evening to all of you, depending on where you are. I really want to thank Dion and the Global Resilience Partnership for joining us in this venture. I want to say just a few things about what we're going to do today. We're going to be presenting the results of some research that have inspired us to gin up the concept of Resilience Plus. We were trying to find some language which would help us capture what we've learned. We see this research not as an end in of itself, but actually an opening of a door, and we encourage all of you, if you find this work interesting, reach out, get in touch. It inspires us to think harder about how to solve these very difficult problems. And again, we hope it provides a door for all of you to do that in your own work. So I'm going to first say just a few words about the concept of Resilience Plus, and then give an example from some work on stress tolerant seed varieties. So Ida, if we could go to the next slide. Okay, so this is just a little diagram meant to illustrate what we often mean by resilience. So for this purpose, I decided to choose the USAID definition of resilience, which I happen to like a lot. USAID defines resilience as the ability to manage adversity and change without compromising current and future well-being. So a way to think about that is if we imagine households traversing through time, as in this diagram, they're showing sort of a small, steady, not exponential growth, but a small, steady growth in family well-being over time. Imagine these families experience a shock that knocks down their level of well-being, at least for a while. And the question of resilience is, how long does it take them to get back to where they otherwise would have been? Those little triangular shaped areas that you see, we can think of those as a measure of lack of resilience, or the resilience gap. And in this particular diagram, we simply illustrate the difference between more resilient and less resilient households. The innovation lab with which I'm privileged to work has done a lot of work over poverty traps over the years. Poverty trap is the idea that if you're knocked down, in fact, you may never get back, and that resilience gap persists for a long, long time. So we've moved from resilience, and the work here, really, the research work and other work began from thinking about resilience to, oops, have we lost the slides? I cannot see the slides either, can you?
Sorry, I'm having some technical difficulties. 1 second, they'll be right back up. Okay.
So let me just keep chattering here for a second. I was going to show you another quick visual. And in the course of the research, which we'll be summarizing for you today, we noticed that when instruments were provided to families to help promote their resilience, not only do we see them promoting resilience, we see more than that. We see what we started calling Resilience Plus. And we're just about to see our diagram of that, okay. I've been teaching with Zoom. I've had about enough of Zoom for my entire lifetime, I think. Funny things sometimes happens. So Resilience Plus occurs when say, a farm family has risk management tools that make them resilient. Because they're resilient, they feel protected against shocks. And then they can safely, prudentially invest and improve their expected level of well-being over what it otherwise would have been without risk management. So we call that Resilience Plus. So in this diagram that we have in front of us, we imagine that in year one, the blue family actually has introduced to it a risk management tool. They respond in kind by increasing investment, and their actual trajectory changes over time. We can imagine a shock comes along. The blue family, we hope, with resilience promoting tools, bounces back more quickly, but they don't bounce back to where they would have been without the resilience tools. They actually go back to this higher trajectory. And hence you can break down these areas in this diagram to the resilience gap, which we saw before, but also the resilience plus gain. So that's where we are. And what we're going to share with you today is evidence that really inspires that way of thinking about it. And for us, I think as a lab, really inspires us to work harder on tools that secure resilience and generate Resilience Plus. We're going to look at a suite of different tools that are out there that have been used, about which research has been done, and pretty consistently, all of these tools are showing that resilience gain that I just illustrated in a hypothetical diagram is typically, that resilience gain is typically on the order of a 20 to 30% increase in income, which is really quite substantial. It really is saying families may have had opportunities before, but they weren't willing and able to bear the risk of doing it. So they implicitly were giving up 20 to 30% of their income. So the rates of return to resilience programs can actually be can be quite extraordinary. I had some of my undergraduate students look at some of the impact evaluation literature and calculate the rates of return that are achievable on Resilience Plus programs or programs that generate Resilience Plus. And they're really quite extraordinary if you think about them. There's also a public finance angle here. A program that promotes Resilience Plus within a population from a government perspective may actually be saving the government money, because the alternative is to leave families non-resilient, non-vulnerable, closer to poverty lines. And potentially that's a more costly kind of exercise. So in the lab, we've done some work, mostly theoretical work on that. So here's what we're going to talk about today. We're going to look, as I said, at a couple of these risk management tools which have inspired this notion of Resilience Plus. We're going to have two speakers, Hava Elabed and Andrew Mude, talking about index or parametric insurance. And Hava will speak to us about West African cotton producers. Andrew's about pastoralists in East Africa. We're also going to have an example of what we like to call flexible financial tools. And Greg Lane is going to talk to us about pre-approved emergency loans for borrowers that also function as a very good instrument and also generate Resilience Plus, as we will see. And I'm going to say just a few words here to kick off the discussion on research results about stress-tolerant seeds. And I noticed a couple of individuals who worked with us on this project, Laura Paul and Jonathan Malacarney. I just saw their faces go by a moment ago. So this work very much is indebted to them as well. So very quickly, what was this project about? This was a study in Tanzania, Mozambique. Tried to combine two resilience promoting technologies, drought-tolerant seeds that had been generated through the Drought Tolerant Maize for Africa project, which was funded by Gates Foundation, amongst others. And we combined that with fail-safe insurance technology. The reason for that combination is that drought-tolerant seeds offer very cheap protection, but they also offer very imperfect or incomplete protection against shocks. Specifically, these seed varieties were bred to withstand what are called mid-season drought stress. But other kinds of drought stresses or other plant stresses, they don't particularly provide much protection to. So we matched or paired this with an insurance technology based on satellite estimation of yields and backed up by an on-the-ground crop yield audit when needed. So what did we see? So we put together, studying resilience, as many of you know who've tried it, is difficult, because to really see resilience, I think, could we move ahead? To see resilience, you need, over the period of the research, to actually be able to observe some negative kinds of events, so that you can see what the impact of resilience are. Either are we able to advance the slide? There we go. So here's real quickly the timeline we followed. I'm not going to go into detail, but you can see above the timeline, you actually see the different sort of events that happened within the project. And we had spread across the 2 different countries, and we carefully chose multiple zones within these countries to try to maximize the probability that within the research period, we could observe a variety of climatic events and see the impact of these technologies. So we had mid-season droughts. Actually, in every year, we had really severe droughts in Mozambique in the baseline year, which was unfortunately before the technologies were developed, and very severe droughts actually in the midline year in about half of the locations in Tanzania. So we use these actual events and their aftermaths to identify the impacts of shocks and resilience. So in the next slide, you can see this is actually based on statistical estimates, but it's just we put it into what we hope is a more digestible form. This shows us what happens to individuals in these communities when they do not have resilience technologies. So you can see the family sort of chugging along through normal years. They're averaging under a ton per hectare of yields. When a mid-season drought comes along, they lose on average about 15 to 20% of their production. When we look at the years following the mid-season drought years, we see most of these families kind of bounce back to where they were, which was not necessarily a great place, but a mid-season drought doesn't seem to knock them down too far. Now, when we see more severe kinds of loss events, and a severe loss event here means where area average yields within a community fell to 60% or less of its average, we see obviously huge drops in maize productivity for these farmers. And then more importantly, we see a real strong post-shock lack of resilience. So it's exactly like that sort of orangish color family in the made up diagram. We see families starting to recover, but only barely. And if we actually look at what's going on under the hood, these families are actually been decapitalized and they're reducing their investment. So the question is, this is sort of the age-old story of risk, knocks people down and may keep them down for a long time. So how do these new technologies work? So here we're displaying the percentage change of the groups that had drought-tolerant seeds and/or drought-tolerant seeds in combination with insurance. And you can see in the mid-season drought year, the percentage gain that these households experience relative to the control group is even higher. In fact, they hold on to their advantage through the mid-season drought. So the seeds that were bred for this purpose actually in farmers' fields actually seem to work. And I personally was very skeptical. I didn't think that would happen. So normal years return, and then the question is, what happens in a severe yield loss? So these households indeed lose things in a year of severe yield loss, but they bounce back. And in fact, they do more than bounce back. And our interpretation here, what's going on is we see following severe yield losses, we actually see families who were in the treatment groups and were made these technologies available to them. They said, we just had a really bad year. I see that these technologies work, and I'm now going to deepen my investment. So we actually see following severe yield losses, we see households in the treatment group deepening their investment by 30 to 40%, and their yield benefits, the trajectory they're now on is much, much higher. So it's a great example of resilience plus. It also highlights, in my final point here, is that it was difficult for us as researchers to study this phenomena. But it's also difficult for farmers in the field to learn about resilience technologies, right? I mean, you can tell people something works, something will protect them, but they may not know. And ironically, we see farmers in the sample who did not experience severe events, they actually start to back off the technology. They use it a little bit and they say, I don't see much difference, right? And so there's something here that I think is pretty substantial that I don't think we've all really grappled with totally in terms of how do we communicate effectively and in a trustworthy way information about resilience promoting technologies. So with that, let's pass the word over to our next speaker, Hada Elabed. Hada?
Good morning and good afternoon. Thank you, Michael, for inviting me to present this work, and thanks everyone for being here today. I'm going to talk about the result of an index insurance pilot that we conducted in Mali. This work was done in collaboration with Michael, Catherine Gerkinger, and Mark Belmar. Next slide, please. So our pilot project was implemented in the Sikasso region of Mali, which is the area shown on the map. And in that region, 58% of the households are poor. Farmers in the livelihood zone of Sikasso grow a mix of cotton and other crops, such as sorghum, maize, millet, but cotton is their main source of cash. And to finance the growing season, the farmers obtain inputs and loans from CMDT, which is a parastatal company that manages the cotton value chain. However, these loans are group loans and come with a binding joint liability condition, which makes the consequences of default really substantial. For example, if at least one producer is unable to pay back his loan, all the other members of the cooperative have to pay back the difference. And of course, this joint liability condition discourages investment. And in fact, the more a farmer produces, the risk of him losing production and using it to pay the loans of those who defaulted on their loans increases. And therefore, we notice in this region that risk prevents farmers from growing more cotton and benefiting from the additional income generated from this cash crop. Next slide, please. So to address this issue of risk facing smallholder farmers in Mali, we designed an innovative agriculture insurance contract. So this contract does not pay directly based on farmers' yield. Instead, it pays based on an average yield in their cooperative, as well as the yield in an aggregated area of about 10 to 15 villages. So in the interest of time, I'm not going to discuss the details of the design of this contract, but my co-authors and I show that this is a very high quality contract that pays farmers 80% of the time when they experience a low yield. Next slide, please. So the Mali pilot tries to answer the following question. Can a high quality area yield insurance contract reduce this risk issue and increase the resilience of smallholder farmers? And to answer this question, we used a randomized evaluation. We randomly distributed the insurance contract to a sample of 59 cotton cooperatives in the Sikasso area. And we kept 28 cooperatives as a comparison group to allow us to capture the impact of this intervention. Our insured unit is a cooperative because the production takes place in cooperatives in Mali, as discussed earlier. Next slide, please. So this table, just to quickly give you an idea of our sample, the farmers grow about 2.2 hectares of cotton and 4 hectares of other food crops. And the household head has on average, is on average 50 years old and had almost no formal education. Next slide, please. So the results of the pilot are very promising. We see that about a third of the cooperative that were offered the insurance contract bought it, which is high compared to other similar pilot programs around the world. In addition, we see substantial impacts on farmers' livelihoods. The farmers who are insured increase the cotton area by between 25 to 40%, and they also increase the amount of input and credits used by a similar amount. And if we consider the cost of insurance for a typical farmer and the additional income generated by this insurance contract, we see that the cost-benefit ratio of this intervention is 6.25. And also subsidizing this, the previous slide, subsidizing this insurance contract by 50% will double this cost-benefit ratio. Next result. So now the important question is, are these results sustainable? So unfortunately, in Mali, there was a coup in 2012, and that stopped the pilot. But luckily, the research group managed to implement an almost identical pilot in Burkina Faso among cotton producers. And a drought in 2012 triggered a payout, and that payout was shown to have led to an increase in the welfare of farmers. Qualitative evidence shows that these farmers benefited from this payout. And currently, this pilot in Burkina Faso is being scaled up countrywide. Next slide, please. So to conclude, this research shows that agriculture insurance can simultaneously be a safety net and income builder, which contributes to the resilience plus of smallholder farmers. And the main takeaway is that in this case, a risk mitigation tool like index insurance provided farmers with enough confidence to invest and plant more of their profitable crop and increase their yields. We also see that the returns to subsidy could be substantial, which has important implication from a policy point of view. And finally, we need to remember that the high quality of the insurance contract was the key driver of this result obtained in both countries. There was a substantial amount of research and work invested to make sure that the insurance contract paid when farmers really needed to have a payout. This means that to be effective, development agencies and the public sector should invest in improving the quality of the insurance contract. And for that, we can see multiple channels. The first is to invest in data infrastructure, investing in global public goods, in soil, weather information that could complement freely available remote sensing data and improve the models that underline the design of insurance contract. Another avenue is to build the statistical capacity of governments and provide them with the infrastructure for collecting data that is used to design the insurance contract. Finally, we see that, second, we see that the public sector could also provide financial and technical support to innovators to encourage the design of affordable and high quality insurance contracts. For example, at the World Bank, we are currently assessing an innovative digital insurance platform that promises to reduce the cost of insurance by eliminating transaction costs. And finally, for smallholders who live below the poverty line, this research shows that insurance has a huge return on investment, which means that the government could also consider subsidizing these contracts for the smallest segment of their population and also at the same time achieve their poverty reduction goals. Thank you.
Thank you, Haddad, for that interesting summary of your research. I was wondering if you could also comment on as to what extent your work in Mali and Burkina Faso also looked at the system level resilience impacts, particularly anything that might be related to environment or ecosystem resilience.
Thank you, Jamie. This is a very good question. So the main research question of the study, this was not the main research question, but we did find evidence that the insurance pilot did not result in negative environmental impacts, such as growing cotton in marginal land that should remain fallow. We don't see a significant change in the area devoted to food crops and other crops, which indicates that there are no negative consequences on households that are not buyers of food. In addition, we don't see an intensification of the cotton activity. We don't see an increased use of fertilizer, which is usually linked to GHG emission and water quality issues. However, the main finding of this research is that by increasing the revenue of smallholder farmers through the sales of this cash crop, the pilot has really positively contributed to their resilience to weather shock. And we don't have evidence for this. We didn't look at this aspect, but we suspect that this additional revenue would lead to less deforestation and land degradation and preservation of the environment. Does that answer your question?
Yes, thank you.
Thank you.
Andrew, you want to go ahead?
Yes, thanks a lot. So thanks a lot, Michael and Dion, for inviting me, and colleagues all for being present. So I'm going to be talking a bit about the index-based livestock insurance program, which encapsulates a series of research elements, but it's broadly a research into development program. As was indicated, I'm now at the African Development Bank, but a lot of this work was done while I was still at ILRI, continues at ILRI, where I left in 2020. So, slide. Thanks. So the context of this work, really the problem that we're trying to solve is focuses on the pastoral population, largely in East Africa. This is quite a huge constituency, both in East Africa, across the Sahelian band, Horn of Africa to Western Sahel, of 40 million people being supported by the pastoral production system. It's also a system that is quite central for the economy at large in Horn of Africa, exports exceeding over 1 billion annually, with the potential for quite a lot more. And also with regards the importance of livestock for household welfare and livelihoods. Median household in this area typically holds 100% of its wealth in livestock. Livestock products and sales account for over 40% of their income. So livestock is critical. And it is also affected by one of the key risks in the area, which is drought, in which regular catastrophic droughts can result in considerable herd losses. In fact, 75% of the herd livestock losses in these areas are due to drought. Michael has already talked about the challenge of poverty traps. This is a system in which researchers identified that there are these livestock-based poverty traps. We fall below a certain herd size level, and it becomes very hard to return back to a growth trajectory. So it's in this context where, move a slide. It's in this context where we began the index-based livestock insurance program, the IBLI program, which was launched. We launched in 2008. It's a program over time that has really benefited from a lot of partners. I think somewhere here you'll probably find the basis CRISP and the assets of market access. So we've also benefited a lot from support collaboration with Michael Carter and his team, many others, private sector, governments, and so on. But really the idea was to, how can we take advantage of this risk management technology of insurance to meet the greatest challenge that pastoralists face. And so we can move on to the next slide. And so basically we launched a research project that eventually became a program to really ensure that support the intervention, support the delivery, and the scale of the product. But it's basically when we think about how an idea or a potential solution to a development challenge that has been identified can go from idea to product backed by good scientific research, and then onto a delivery. The key elements of the program that underlie the IBLI program had to do with a precise contract design. Of course, if you are providing insurance coverage against drought-related livestock mortality, you want to make sure that the contract is actually covering that risk. This was a contract using satellite data, natural normalized difference vegetation index, which is a satellite reading of vegetative vigor, to scan the state of forage in the rangelands in terms of how much was available for livestock feed. Pastoralism is a production system that relies almost exclusively on inputs from the rangelands. So important that the contract was focusing on that risk. Then, of course, we want to make sure that if we are trying to ensure the delivery, sustainable delivery of this product, that other than the theoretical value, that we establish that there is value at the household level, and also economic value for any public provision, and the product has impact. So a lot of work was done there, and I'll touch a bit more on this. Then, of course, this is a population, pastoralists, relatively vulnerable population, a population with lower than average education, a population that typically, not just financial products, but did not have the experience of insurance in the system. And being marginalized areas, usually the arid and semi-arid lands in which pastoral populations apply, are difficult to get to, infrastructure deficient. So how do you deliver this product to them? And then finally, start thinking, working together with government policymakers. What is the institutional structure that's available, both public and private, to be able to deliver cost effectively the product and allow it to scale. So these are just the broad basic elements of the program. You can go forward. And so, centering on the evidence of impact and value. I think this, particularly when it comes to getting to scale, is critical that you can show, particularly to those partners who will eventually invest, whether it's government, it's commercial players that need to underwrite the product, deliver, or even development partners who support the growing steps of the research to development agenda, is basically identifying impact and value, as I said. And so in the IBLI program, we established a comprehensive research infrastructure with household level surveys in northern Kenya, about 900 households, starting with a baseline in 2009, about 6 years of panel. In Ethiopia, about 500 households, starting in 2009, about 4 years of panel. And basically, this allowed a rich source of data that allowed us to establish the benefit of insurance in these ways. And this is really the insurance plus dividends that Michael was talking about earlier. You see positive impacts on production and welfare, as expected, increase in herd survival rates. Those households who are covered by insurance are investing more in maintaining their livestock through the purchase of veterinary drugs and other input services. Also, we find households that are covered, that took out contracts, had improved production outcomes in terms of milk productivity, and also experienced positive impact on children under 5 in terms of the mid-upper arm circumference indicator of nutrition. Also, improved coping strategies. What we find is that households, this is after the drought in 2011, where there was a payout. Almost all households that had insurance had a payout, so we're able to test what their response was, and we find that households who had insurance were less likely to sell off their livestock, and particularly those with herd sizes above the poverty threshold in this area, about estimated between 5 and 6 tropical livestock units. That's about equivalent to 1 head of cattle. And you find that in this population, insurance allowed them to hold on to their livestock, and in essence, really protected them from that falling below the asset threshold. And you also find, particularly for households that were more vulnerable, that they were able to, households with insurance were 25% less likely, to reduce the meals for children under 5. And of course, this relates to the previous finding of positive nutrition impact, and of course, very important in terms of long-term economic outcomes, if you get it. And so, once we're able to establish this is when we're able to get, additional support, development partners. We had the Kenyan government come in and demonstrate an interest, in fact, invested in what they call the Kenya Livestock Insurance Program. This program differed slightly from IBLI. It had the same underlying contract, but with IBLI, households were actually purchasing the product. They were purchasing on the basis of the actuarially fair premium. Anything above that was supported by donor resources. But the Kenya Livestock Insurance Program identified vulnerable households and essentially provided them with fully subsidized contracts covering about 5 head of the equivalent of 5 head of cattle. And over the years, since 2006, CLIP still maintains and has been growing over in terms of the coverage and in terms of the area in Kenya. Since then, since inception, about $10 million US of payouts have been distributed. And we see that now in Ethiopia, we had a pilot, and the Ethiopian government, on the basis of some of the learnings of the CLIP, the Kenyan government's program, has also instituted a process by which they're looking to invest in IBLI, and also several other countries across the Horn of Africa and West Africa as well. Next slide, please. And so on the basis of that experience, it is how do we consolidate that experience to ensure widespread sustainable scale? Basically, the evidence is quite clear on the social economic benefits of the program, also of the savings, the fiscal savings, and fiscal benefits of governments that would otherwise have to use those resources to respond to drought-related disasters in efficient ways. And so, this actually also relates to the program where the division that I manage has a climate smart agriculture component. We are designing regional projects for the Horn of Africa and the Western Sahel, 8 countries in the Horn of Africa, Western Sahel. This is building resilience against food and nutrition, a program in which the team had indicated a component for climate smart insurance, and of which we are targeting now an index. But in terms of how the feasibility studies that we put in place to ensure whether a country has the relevant institutional infrastructure, the relevant set of partners to determine where in the continuum or toward from a research to a sustainable program one would need to invest. We use a lot of the lessons that have come from the IBRI program and some of the others that we've been working with our partners to be able to guide that decision making. But really, we do believe that in terms of getting to sustainable scale, a very structured public-private partnership is what is required, and that is basically also at the African Development Bank how we are approaching it. Thank you.
Great. Thanks, Andrew. Samuel here. So just speaking about the scale and replication of this program, could you share with us related to specific public or private goods that resulted from both the pilot as well as the within the different countries? So that's both Kenya and Ethiopia. Were there specific, public or private goods with the potential to sort of kickstart replication or scale across a wider range of environments or sectors or countries with respect to this particular initiative? Thanks.
Well, thanks. Yeah, certainly in terms of the public goods. I mean, I think mostly what it is an understanding of the process and prerequisites that need to be in place to increase the likelihood of a scalable, economically viable, and sustainable program of index-based insurance or related program. And these are really the 5 elements that I mentioned. So in terms of public good, when you're talking about contract design, I think Gada also mentioned the importance of having good data infrastructure, both for the design of the contract, but also for triggering and for vetting the product. I think one of the elements I also mentioned was this is the generation of global public goods of research of evidence and the value of these programs. A lot of the research also was not just on impact at the household level, but also action research on how do you get a population that has not had experience with insurance, let alone satellites. How do you get them to trust the product? How do you get them to buy into the product? And so a lot of work was done on adoption, and that work is there in the public space, but also in terms of the partnership, the mix of public-private players. For example, in CLIP, it was quite clear that while the private sector needed to be incentivized initially to be involved, they also needed the capacity to be built with regards to index insurance. I mean, the livestock insurance program was one of the first experiences that any Kenyan or Ethiopian insurers had with the index insurance concept. So there was a lot of capacity building work that needed to be done, but also a recognition that the best way to get to the target client was through a well-equipped commercial insurance entities. I think finally, I'd also say you asked specifically with respect to smallholder risk, directly targeting smallholders. If the idea is that smallholders, like in the initial IBRI product, are actually purchasing, as opposed to where our government is paying full subsidies. And even with CLIP, the whole idea was that over time, the government would reduce its subsidies, which means you need to make sure you're getting to the smallholders. So for that, the KYCs, how to organize your KYCs, how to organize quality control, how to organize extension is a real big part of what is understood as necessary in the process of getting an economically viable livestock insurance sector underway.
Thanks, Andrew.
Thank you.
Great. So I guess I'll start up. Thank you for having me. So I'm going to be talking about using credit for Resilience Plus, so a bit of a different potential solution than what we've heard about in the past two very interesting presentations. So the reason we even thought it was useful to think about using credit as a potential solution for this was because of two core problems, where sort of the second was a direct result of the first. So the first problem was that, we've seen really promising results from these index insurance schemes, but insurance isn't always workable in a given context. So first, demand for insurance is sometimes quite low. People might not understand the product. It might be very difficult to create an appropriate sort of robust index insurance product for a given risk. And so people might not want to buy it. And if they don't buy it, then they can't benefit from it. Another problem was, even if you have a good product, it might be difficult to find a provider that's willing to sell it, particularly over the long term. So for these reasons, we thought maybe we can use credit as an alternative risk management tool. But the problem with credit to fill this role is mainly that credit after income shocks tends to dry up. So banks and formal lenders are going to be very reluctant to lend to clients in the aftermath of a shock, because they don't look particularly credit worthy. And so if this access to credit is uncertain, households are going to lose sort of this resilience gain, this higher investment in the planting season that they would otherwise get, because they can't plan ahead. They don't know that they're going to have this credit available to them if they actually need it. So our potential solution to this particular problem was to actually pre-approve households pre-shock, so sort of in the planting season, based on their credit history. And we sort of tell them that you are guaranteed access to credit of this amount if a shock affects you this season. So specifically, we sort of looked at a new BRAC product that offered guaranteed credit after a flood. So next slide. We worked with BRAC in Bangladesh with their microfinance arm there, and we sort of thought this was a useful place to start with this new product, because Bangladesh is very susceptible to flood. So it's a delta for 3 of the world's major rivers, and 60% of rural employment is in agriculture. So sort of flooding is sort of the primary risk that farmers are facing in that context. BRAC was sort of well equipped to try this out, because they have a very large microfinance operation and many other operations throughout the country, and they have 2,000 branches and reach upwards of 4 million households. So together we sort of developed a new product that we marketed as the emergency loan, specifically to address this flooding risk. And the key component of this product that was new was this idea of pre-approval. So before the flooding season actually began, sort of before the planting for the monsoons, we told BRAC clients that they were pre-approved for a loan should they want it if a flood came. And so this pre-approval was based on sort of past loan repayment behavior and their current debt levels. We conducted a 2-year randomized control trial of this product on a sample of 300,000 rural households. So what did we find? Sort of what are the main headline findings? They're surprisingly similar to what we saw from the previous insurance examples. So in the treatment group, sort of at planting, we saw an increase in the amount of land cultivated. So rice cultivation among treated households actually rose by about 20%. And we also saw an increase in the probability of growing any crops at all, so by about 9%. So a lot of BRAC's clients were actually landless and would sometimes rent land and sometimes not, and this seemed to encourage them to cultivate in a given year. The next thing that we looked at was sort of what happened at harvest. And so here we have 2 states of the world. You either experienced flooding in that year or you did not. So in areas that did not experience flooding, we sort of see this sort of resilience gain. So treated households, when they didn't experience flooding, were able to reap 33% more crops. And this is sort of consistent with the amount of extra land they planted. So they're actually benefited in years where they did not have a shock. When they did have a shock, we see that affected households in treated villages we're able to maintain 10% higher food consumption per capita relative to the non-treated households that were also flooded. And we also see them maintain higher levels of livestock. And so this is almost identical to what we saw in Ethiopia and Kenya and that Andrew just presented, where households were less likely to sell off some livestock in order to sort of fund current consumption, and they're able to maintain their level of productive assets. So this is nice because, you know, for this project in particular, we sort of see that guaranteed credit in this context was able to achieve very similar benefits as sort of the index insurance products that we just looked at. And sort of more broadly overall, this sort of suggests that multiple types of risk mitigation tools can be used to generate these resilience plus impacts. And so that could be the insurance we've talked about, something like guaranteed credit, or you know, potentially innovative savings products. And sort of what particular mix or what particular product is appropriate for a given context is going to depend on a lot of specific factors. You know, the types of risks specifically that households face, and, you know, maybe more importantly, just the availability of local partners, the capacity that you have to reach people with a given type of product. So, you know, this was the first, you know, test of this sort of guaranteed credit product. So there's a lot that we don't know, and we need to look more in the future. So just a couple examples of research questions that we're hoping to answer moving forward is, you know, maybe most importantly, are the results consistent in another setting? So we worked with BRAC in Bangladesh, and they're a exceptional partner. They have a long, deep history in Bangladesh with very good client relations. So, you know, it's important to try this out with a partner that maybe doesn't have that history. It could be that flooding also is unusual in that in the aftermath of the flood, households actually have quite a good investment opportunity. They have their, you know, damp sort of new field that has new soil deposited on it. So we want to see maybe, does this also work for things like droughts or cyclones? And we're hoping maybe to be able to test this out, as BRAC Uganda has sort of hinted that they're interested in pursuing this idea in their setting. Other questions we might look at is, you know, how sustainable is something like this over a longer time horizon? So we are able to look at this for 2 years, but, you know, you might think that things are different after 5 or 10, particularly with something like credit, where you sort of build up potential debt stocks that may be unsustainable. And it's also important to think about what types of households are reached by different types of products. So are the households reached by credit different than those that we can reach with insurance, maybe different than those that would take up a savings product? Yeah, so that's all that I have for this. Thank you.
Greg, Dion here, a quick question. How important was it for you to understand the needs and context of some of the users or clients of these products? And you mentioned working with BRAC, who has good local relations and good understanding, clearly, with many of the communities you're working with. But I presume, you know, getting a clear understanding of the needs and context would be important for this work.
Yeah, yeah, absolutely. So when you're working with BRAC, and in this context, you know, obviously we were limited to the sample of microfinance clients that had previously worked with BRAC. So BRAC sort of understood them quite well. And these households, you know, they are quite poor still. So the product that we built this on was called the Dabi loan, and Dabi literally translates as poor. But they were not sort of the ultra poor, as using BRAC's terminology, which are sort of the poorest of the poor. So these sort of moderately poor households, we targeted them specifically because we thought that they would be able to, and based on their repayment history with BRAC, be able to successfully manage a credit product like this, where they take on debt to manage this temporary shock. And so we relied on BRAC knowledge that they said, yes, we think this will work. We did not test it on the ultra poor, specifically because we didn't think this was appropriate for their needs. So I think it's definitely important to understand that and think deeply about that when you're choosing between sort of maybe a menu of options. Within that, however, you know, we thought we were concerned that sort of this product would only be helpful for relatively wealthy microfinance clients versus the relatively poor within the sort of this pool. But we actually didn't find that. So actually, the most reliable borrowers and the people who were more likely to be pre-approved and sort of did best with the product were actually on the poorer end of the distribution. And I was maybe surprised by that, but BRAC actually wasn't. And I think what they said, and I think this has been confirmed by other microfinance institutions, is that the poor microfinance clients actually tend to be the most responsible and have the best repayment rates overall, and seem actually better able to manage debt than others. So this seemed to benefit actually the poorer section of their clientele rather than the richer. But sort of thinking deeply about what's appropriate and what's manageable and what people need, certainly important. Okay, thank you.
Great. Thanks, Michael. So good evening, good afternoon, good morning again, everyone. Samuel Senyimba from the Bill and Melinda Gates Foundation. And I will spend about 5 minutes at most just running through broadly a program within the foundation that's focused on a couple of the work streams that have been highlighted here, and sort of give a sense of how it all comes together. So next slide, please. So within the foundation, this work is really sort of seated under the Agriculture Development Program. And our overall goal within that program is to support country-led inclusive agriculture transformation, focused on Sub-Saharan Africa and Southeast Asia, with a focus on sort of developing product, services, and policies that benefit smallholder farmers, empower women, and improve nutrition. So when we talk about agriculture transformation or country-led agriculture transformation, sorry, next slide, please. That slide right there illustrates our thinking and highlights where we focus. So, there are different stages from 0 all the way up to 4 that countries go through. And the focus of most of our work and partnerships is really sort of partnering with governments and the different partners to transition through stages 0 to 2. With a focus on increasing productivity, ensuring that it delivers the anticipated or expected outcomes, but more importantly is inclusive, and therefore that could be either social, geographic, or economic. Next slide, please. Within the Agriculture Development Program, they are about 11 portfolios that cut across different aspects. So you will see there that those sort of run from innovation, enabling environment, and country focus. But I would like to draw your attention specifically to the accelerating innovation portfolios, where we have the crop discovery, the seed systems work, the livestock work, and the digital farmer services work. And this is where you would probably categorize a lot of the initiatives, the work, the research that has been mentioned within by the different sort of partners within this meeting. And so one of the things that we are increasingly trying to do is to link across the different sort of portfolios and bodies of work to ensure that, for example, when we start talking about things like Resilience Plus, we're picking up the work that's being done by the seed systems folks, some of the work that's being done by the livestock folks, and connecting it to the delivery, which is being undertaken by the digital farmer services. So maybe I'll spend 1 or 2 minutes to just dive deeper into a couple of those portfolios to illustrate what I'm talking about. Next slide, please. So that just highlights the collaboration. We won't spend too much time on that. Could we move to the next slide? Right. So that was one of the portfolios that I highlighted, which is assist systems and variety improvement work. The focus of that portfolio is really to develop and continuously deliver improved crop varieties that are high yielding, more nutritious, more importantly, have a focus on women farmers. And we have undertaken a number of engagements and partnerships under that. One of those that was mentioned within this call was the work with CIMMYT. So our partnership with CIMMYT is focused on strengthening sort of maize breeding networks, developing hybrids that are adapted to drought. So when they talked about the drought-tolerant maize, that was in part a result of some of these partnerships. We do have other partnerships that are focused on other staple and related crops that look at drought tolerance, virus resistance, and so on and so forth. So this is one of the key portfolios that's focused on some of the technologies that are related to climate adaptation. Next slide, please. Next slide, please. And then we have the digital farmer services, which is primarily focused. Sorry, just go back one slide. Thank you. That one is primarily focused on delivery. So farmer-facing delivery, where we are looking at ag advisory services, inclusive finance, smart farming, and taking a sort of a digital lever to ensure that we're able to accelerate sort of the efficiency and inclusion angle of getting the products and services that are being developed by our R&D teams or upstream work. So a lot of the work that we do within this particular portfolio also focuses on integration. And so how do we, for example, within our inclusive finance portfolio, look at bundling financial products, risk tools with some of the work or the products that are coming out of the Savvy portfolio. So when we talked about the drought tolerant maize, and we talk about insurance that could, in this case, be index insurance, yield index insurance, are there innovations that enable us to bundle that insurance with those products towards a more broad sort of resilience plus agenda? And so the work within the DFS portfolio is focused on that, and we link that up with some of the other portfolios, not just for the crop, but also for the livestock. And increasingly, we're looking at what the other partners across the board are doing, whether within these respective portfolios or across, which is why the work with UC Davis is of extra interest to ourselves. Thank you.
Thank you, Samuel. I think in closing, I just wanted to say that these presentations really bring home for me the importance of supporting long-term solutions and empowering local ownership in an increasingly risk-prone world. So, research on risk management tools and approaches such as the ones that were discussed today, I would say really provide USAID and other development actors with the information, data, and really some of the methods that we need to design and implement evidence-based approaches for strengthening key resilience capacities that we really feel are critical to achieving and sustaining development outcomes in the face of shocks and stresses. And so from USAID's perspective, I think Michael gave a really nice accessible definition for resilience, but our official one is that resilience is the ability of people, households, communities, countries, and systems to mitigate, adapt to, and recover from shocks and stresses in a manner that reduces chronic vulnerability and also facilitates inclusive growth. And so, we're really trying to flip the conversation away from focusing on vulnerability and really on focusing on those capacities that we can work to strengthen these development outcomes. And so for USAID, in terms of our resilience portfolio, for us, resilience is not simply good sustainable development. It's, we focus on working in those regions subject to recurring crisis, particularly where chronic poverty overlaps with repeat large-scale emergencies. And so this also means that we recognize that shocks and stresses are really perennial features of these landscapes in which we work and not anomalies. And so that we explicitly design and implement our approaches to take this into account. And so the panelists that we just heard really provide several examples of innovations that can enable households to successfully manage, in the case of these innovations, primarily climate-related shocks to their livelihoods. But recognizing that these approaches are really needed for the holistic sort of complex risk environment that the people that we are working with live in on a daily basis. And so, secondly, with our resilience portfolio, we really seek to align our investments with country-led efforts and support and engage with partner governments, the private sector, communities, and other local actors to really share that responsibility for managing risk, building resilience, and responding to shocks. And so, for instance, the earlier presentation on the index-based livestock insurance research really provided an excellent example of how governments can then scale successful resilience innovations that are piloted through research and early implementation and of development programs. And then finally, we do focus on working across sectors with our resilience portfolio and engaging with both humanitarian and development actors in joint problem analysis and design of solutions. Really recognizing that it's not just one approach here that's going to work. And so we really, in order to really strengthen these resilience capacities that I talked about earlier, it really requires more of a systems level approach, particularly in these landscapes where highly vulnerable people are really being affected by these significant shocks and stresses. So I think at this point, I'd like to pivot to the part of this webinar where we're really going to hear from all of you, the participants, with your questions and really get that going. So to kick us off for this Q&A portion of the webinar, I'd like to turn this over to my colleagues, Sophie and Ida, to lead us through that process. Thank you.
Thank you, Jamie. I've been collating the questions as they've been coming in from the chat, and we've got a couple great questions that I'd like to throw out there. I guess we can kind of work chronologically as they came in. We have one question from Berber, and this one will be, I think, for and I guess Michael as well. She's saying that these are interesting findings, talking about resilience. Shouldn't we be looking at incomes or consumption instead of yield gains? So if you want to take that on.
Hi, Sophie, I didn't hear you. Did you say that it was a question for me?
Sure, if Hada or Michael, if talking about resilience, shouldn't we be looking for consumption instead of yield gains?
Okay. I let Michael answer that question.
Michael, you want to jump in there?
Okay, sure. No, I mean, hi, Berber. So that's a good observation, and I think I don't know about all the studies we've talked about, but certainly you do want to follow the chain all the way through. The emphasis we tried to give here was Resilience Plus is actually about investment that is permitted even before shocks occur because people have confidence. So in a sense, what we were doing and highlighting here was the focus on the earlier parts of the chain. The drought-tolerant maize work that I mentioned, we actually do look at various kinds of consumption and food security outcomes, and we do see results that are largely consistent with what you might expect to see if there's actually increases in family income. How those work, I know, was cut short because there was a military coup right after that harvest was realized, so we actually were never able to follow up and find out what happened on the consumption level. But some of what Andrew obviously talked about follows it through to the consumption level. But you're quite right, it is. And I guess one thing to point out, generating Resilience Plus means that you're changing behavior, you're changing opportunities for investment. And for a given budget, obviously that means something has to give. So if you're expanding the pie a little bit, but if families invest a little bit more, it may be, and this has been seen in a number of other kinds of programs, it may be that the actual consumption gains are kicked down the road a little bit. So it's a great question. It's something we need to keep tabs on.
Thank you, Michael. We have a couple questions that came in for Andrew. Andrew, I have here, let's see here. The Italy work sounds great. However, how are these initiatives sustained in the future? How are you thinking about sustainability aspects? And that goes along with another question about how is this kind of project sustainable without subsidies? Do you want to tackle that quickly, Andrew?
Okay. So thanks a lot. I mean, this is a great question. I should say, in fact, early on we were focusing more on the commercial viability of the program on the basis of some willingness to pay work that we initially did, and we ended up over time, just given the as you know, we started this in 2009. There was a big drought in 2011. In 2013, it changed the risk profile. Also, the challenge of delivering the product is much costly to deliver in the pastoral production areas. So the premium loadings for commercial sustainability were quite a bit higher. But we then changed into more, once we started to get information on the impacts of the socioeconomic benefits that accrue to households with insurance. And also, therefore, the benefits to the government, the fiscal benefits to the government who are providing insurance was a more cost-efficient way for the response to droughts they otherwise would have to make. So we started thinking about this from an economically sustainable point of view, not from the point of view where the pastoralists themselves need to pay the full cost, but where there was a smart subsidy that made sense, a smart public subsidy that began to make economic sense because of the benefits that were accruing. I think these are some of the resilience gains elements that Michael was talking about. And also just in terms of context, much of the over 90% of the volumes of in the insurance sector for agriculture across the globe in both development and developing countries are subsidized in a way. So demanding commercial sustainability or commercial viability from a pastoral product, given the vulnerabilities that they face, was a question that we had to tackle. This is why in the end we felt economic sustainability was the right type of model. And that we believe is sustainable, where now governments are working in public-private types of setups to ensure scale.
Great, thank you, Andrew. We have a follow-up if you want to stay with us here. This is from Dan Kango, that he's been studying farmer entrepreneurship and farmer trader relationships that maybe leverages capacities that enhance farm resilience to climate change. Did you see any indication of these capacities playing out in your IBLI project, and what's your view on this? This is farmer entrepreneurship and farmer trader relationships.
Okay, so to the sense that the way that I understand this question, first of all, in terms of pastoralists themselves, learning about the value of this product, that required a lot of engagement with it was actually the agents. So initially started work, the insurance company that was underwriting started working out with the bank in the area, Equity Bank. But the banks, the outlay for the banks were too expensive in terms of infrastructure. So they needed to start to work with agents who are called village insurance promoters at the local level, who are earning some sort of earning a commission on the payment. So to the sense that that kind of provided a new income stream to the local community. that that might also demonstrate in terms of pastoralists in entrepreneurship. But I think more what we began to see more over time as we start to see pastoralists repurchasing the product is a learning of the value of the insurance product. And we get a lot of questions around, these are relatively cash poor populations, but you'd find that pastoralists who are otherwise very skeptical of selling off their livestock were at times willing to do so if that allowed them to get the resource to protect more of their the rest of their herd. So in that way, they were updating their priors.
Thank you, Andrew, for that answer. Okay, we have one, I think that would go nicely to Jamie and perhaps Sammy. This is kind of asking from a donor perspective. How much of the technology innovations that you guys are supporting that you know of may require additional labor? And have you confirmed that this labor is available or has sufficient dietary energy to fuel that labor for sufficiently timely operations? So this is looking at kind of these unintended consequences of some of these innovations. Jamie, if you wanted to start, and maybe Sammy can jump in there.
Sure. I mean, I think that's an excellent question, and one that we think not just in the context of these specific innovations or things that might be on the research end of the types of approaches that we use, but this issue of time poverty and labor requirements, particularly for women, is a central consideration in really all of our development programming, and certainly in these types of vulnerable communities where that might be an issue. So I would say that we very much do think about that and how then when we have development programs, how they're implemented and what things we might be asking people to do.
Sure.
And I'm not sure if you wanted to speak a bit.
Sorry, no, I was just going to add from our side, sort of like was illustrated in one of the slides. There's two sides to this. So there's technologies that we consider sort of related directly to production and productivity. So essentially, it's better yielding crop varieties or animal breeds, and cognizant of the fact. I think sort of gender and women specifically sit front and center across all our portfolios and bodies of work. And so we're cognizant of that as the different, as we sort of engage with the different partners. I think on the digital technology side, we're also cognizant of the fact that there's still a gap in terms of aspects like ownership of mobile phones or access to mobile phones or connectivity, or just generally literacy in terms of using mobile. And if we're going to start pushing a lot of the partnerships towards delivering via that channel, does that mean that inadvertently we're sort of excluding women? And so we're cognizant of that and build that into all the engagements that we have with our partners and the different stakeholders. Thank you.
Great, thank you. Does any of the do any of the other folks, Dion, if you wanted to jump in here?
I think those were great answers by Jamie and Samuel. Thanks, Sophie.
Okay. We have one kind of good generic question here that came in from Dick Tinsley. His question is, isn't resilience the same as risk management? I feel like quite a few of you could jump in with your opinion on this. Michael, do you want to start?
Sure. I mean, I guess I would say risk management promotes resilience, and resilience promotes resilience plus. So they're all sort of tied together. But without splitting hairs on language too much, I see risk management as a set of tools that then make people resilient. And then it's the knowledge and the confidence of that ability to bounce back that has prior effects. And this is, I think, is a really important point to make, based a little bit on some of the side chat, but also I know conversations that Andrew Mude and I have had around livestock insurance, that, the work we've done, it's important to emphasize our sort of behavioral change, investment behavior change that's occurring before shocks occur. And for people to do that, they have to know that should a shock occur in the future, they're protected. And one of the issues Andrew and I've discussed in the case of livestock insurance is very interesting. When the government began to scale it up, Andrew and I, of course, were really happy and glad to see that. And yet there was a concern about whether the scaling was taking place in a way that fully informed people and gave them the confidence to make those kinds of, before the shock occurs, sorts of behavioral changes. And I don't know, Andrew, do you want to chime in on any of the things we learned about that?
Sure. Sorry, my internet connection is a bit unstable. I think I heard most of that. I mean, what I would say, linking to your response, Michael, is that resilience is the outcome of good risk management. And in this case, you've got a tool, index-based livestock insurance. We talked about the different elements that would make it an effective, cost-efficient tool, a good contract, and so on. But one of the things I mentioned earlier, in terms of the Kenyan government over time reconsidering the provision of free insurance, not only because it would then be too costly, but because the original conception of the product, in which pastoralists were actually paying, suggested that they would, that they were willing to pay to some amount, a subsidized amount, but this was a way that promoted learning. From them, it also promoted one of the challenges that the Kenya government program was facing, is that it's easy to identify a beneficiary, and but in terms of ensure that that beneficiary is worthy, ensure that that beneficiary has details that allow for efficient, quick delivery of premium payments, was very difficult to do. But if the government would allow for individuals at least to pay some positive amount, they could then get KYC, customer details. They could make sure they have a mobile phone account to which insurance was delivered immediately, and their product, because they at least were going to invest in a certain way. So these were all the lessons that are required to make for greater resilience, both at the house level and with respect to the value it gives to the public provider.
And I think also I'd like to jump in a bit to address that question too. I mean, I would echo Michael in that risk management approaches and tools are very important to strengthening resilience capacities. But one thing that we've also learned is that there are really from sort of the evidence basis showing that there are what we would say key sources of resilience that transcend these technical approaches and these technical sectors. And so things like social capital, which is the ability to lean on others in times of need, or women's empowerment, or social inclusion, and then all of the psychosocial aspects of sort of your confidence to adapt, your aspirations and your hopes for the future. These can have very important, these are very important factors that affect a household or an individual's ability to really manage through shocks and stresses. And so I think from our perspective is that risk management approaches are very important to resilience, but it's not, there are other things that really feed into your ability to then manage, to take advantage of these risk management approaches and tools. Over.
Sophie, maybe I'll say just a word there, because I saw a couple of questions go by talking about, there's one particularly asking about insurance and the current COVID crisis. And I think it ties in nicely to a point that Jamie just made. I'm working with people, the International Livestock Research Institute, on sort of a continuation, if you will, of some of the work that Andrew described, and in particular, looking at it in combination with graduation programs that build up business assets for women in these pastoralist communities. One of the questions we've been asking ourselves is what's happening in the time of the pandemic to these businesses and et cetera. And one of the things we're going to be investigating as best we can over the next few weeks is, does participation in these kinds of more general programs, does it enhance other assets? Because obviously livestock insurance is not paying off because of the COVID virus, but have other things been put in, have other processes been put into motion? And we're looking at a similar, possibly looking at a similar set of questions in Nepal around some programming that Heifer International has been doing for a few years, where, you know, part of what they're trying to do is obviously transfer livestock assets, but they're also trying to build up a full range of human capacities. So an interesting question that the COVID and those kinds of uninsured events put to us is, are there other capacities that are created that actually allow people to deal with uninsured shock? So we hope to be looking at that, and it's a really interesting question, I think, to consider.
And Michael, I'll just jump in here as well. Dion here. I think this, you know, for us, resilience goes beyond risk management in two ways. And the first is resilience about dealing with uncertainty. So if we look at, you know, the types of shocks that we're experiencing these days, quite often we're seeing these compounding shocks. So we're dealing with a COVID-19 disruption at the moment, global disruption, but at the same time, many countries in South Asia are also dealing with cyclones that are hitting those areas. We're seeing locust outbreaks in Africa as well. So we have these compounding shocks, which are very difficult to predict. So there's that unpredictability, uncertainty element, which is important. And some of those capacities that Jamie speaks about become very important when you're dealing with those uncertain times. The second component, and which links, I think, very closely to this resilience plus approach that Michael and his team are promoting, is that, you know, resilience, or it goes beyond risk management and not just bouncing back to where you were, but actually transforming trajectory into an even, you know, more positive trajectory potentially. And I think for us, that transformative component of resilience is important. It's not just bouncing back to where you were, but it's potentially changing trajectory into a new positive trajectory. So I think that's where we go beyond thinking of this as purely risk management.
Great. So Sophie, did you want me to go ahead and wrap this up, or do we have time for one more question?
I think, yeah, I think your final comments would be great right about now. Thank you, Michael. Okay.
Well, Dion just provided a great summary of I think the motivation and why we're all here. We certainly want to thank everyone for participating. I've been watching the questions as best I can. I know we didn't get to them all, but it seems like we really engaged a lot of important people to think about these issues. The one issue I noticed we didn't really get to was kind of the completeness of the protection, or in the insurance language, the basis risk that might be attached to some of these. And those are all really, really important kinds of questions. I mean, no instrument can maybe solve everything, but we certainly need to be attentive to the quality. Those of you interested in insurance, the Innovation Lab has a program called QUIC, Q-U-I-I-C. You can find it on our website, or Sophie perhaps will send it out, that actually specifically considers what you can do. Remote sensing is moving fast. Terrestrial weather stations are really no longer the issues. I think those are dominated by other technologies, but those technologies are far from perfect. So, you know, getting the complete package, or a package that is sufficient to generate Resilience Plus, is, I think, something we need to keep working on. And indeed, that was the gist of the drought tolerant maize combination package with index insurance. Anyway, there's a lot to learn. For me personally, I would love to see a more integrated package. You know, the kind of stuff that that Greg told us about, I think is super interesting. Integrating savings into these things. I mean, there's a way to combine and blend financial and agronomic instruments into what may be relative, that sounds complicated, but I think if we do it well, it might be less complicated. So again, thank you all for your attention. And on behalf of the Markets Risk and Resilience Lab, we really appreciate you joining us here today. Sophie, anybody else want a parting word or?
No, thank you very much everyone for coming. We're gonna post a exit poll up if you have a moment to answer some of our questions. It's good for our monitoring and evaluation of our efforts. And please do check in on our website. It's basis.ucdavis.edu for more information. And we will post the recording of the event, plus additional resources, additional answers to the Q&A that we didn't get to today. So do check in a few days for the rest of that information. Thank you very much.
Thank you, everybody. Appreciate your time.
Thank you. Bye-bye.
Likewise, thank you.